Welcome everybody. It's just after 2 p.m. on a winter's day, and I think it's fair to say that whereas US equities are never not a major topic of discussion for investors, it's perhaps the case that they're more of a topic for discussion than they usually are at the moment. It's writ large over most of the market commentary, the extraordinary valuations that some of the largest companies in the US market have reached, and equally the disparity between those valuations and other segments of the US market and indeed other markets. So it's a really good time to think about an investment strategy that takes a little bit of a different approach to kind of core US equities with more of a value bias. And so I'm really pleased to say we have Steve Farkas today. Thanks for getting in early Eastern time, Steve. Steve's part of the team that looks after BlackRock American Income Trust, and he's going to speak for about 15 or 20 minutes on the strategy and outlook, and then there'll be a chance for Q&A. Do please type in any questions you have during the presentation. I'll be in the background reading those, and we can start a conversation once Steve's concluded with the formal presentation. So with that, I'll hand over to you, Steve.
Terrific. Well, thank you, Alan, and thank you, everyone. It's a pleasure to be here today. As Alan mentioned, my name is Steve Farkas, New York-based, and I work closely with the income and value team here at BlackRock, which manages the American Income Trust. And what I'd like to do today is I'll provide a refresher on what the trust does and how we go about doing it briefly. And then I'll spend the majority of the time going through some slides to talk about our outlook in what is a pretty fascinating time, as Alan mentioned, when it comes to US equities. We are seeing some really interesting sort of simultaneous phenomenon, particularly around value versus growth, market concentration, and how those are playing out today in the market. So I'll speak to that in just a few minutes. But at the top of the call, what I'd like to do is spend just a moment here refreshing everyone on the objectives of the BlackRock American Income Trust and share with you a few characteristics of the company. Well, first and foremost, the objective of this strategy is to provide an attractive level of income and capital appreciation over the long term. But in addition to that, we have what we would call a dual objective, and that we also seek to provide a premium ESG score relative to our benchmark as measured by MSCI. And the team that runs this portfolio, you can see in the top left, these are some of my colleagues here based in New York City. Tony DeSpirito, who in addition to being a portfolio manager for the strategy, is the head of BlackRock's $70 billion income and value team, the team that manages this portfolio. He's also the global CIO for fundamental equities at BlackRock. So he offers really good perspective in looking at things, not just in the US, but relative to the rest of the world. And I'll touch on that in a few minutes. And in addition, there are two other named portfolio managers, David Zhao and Lisa Yang, both of whom have vast careers in terms of experience, and also New York-based with myself. Now, a few statistics or measurables on the trust that I think are worth reminding the audience. But first of all, this is a strategy, as Alan mentioned, that has an investment style that can invest in multi-cap, meaning we tend to prefer large cap stocks, but we can also invest in mid-cap companies as well. And the number of holdings in the portfolio tends to be between 30 and 60 individual stocks. And we are benchmarked against the Russell 1000 Value Index, which I'll touch on in a little bit, just regarding some of the interesting valuations we're seeing on how this is quite discounted relative to other parts of the market. And as you can see there, there's a bit more statistics on some of the ESG objectives as well of the trust. So that's a little bit on the actual portfolio and some of the characteristics and the managers of the strategy. What I'd like to do now is move on a little bit and share with you the outlook and some of the perspective of the market and what we're seeing today and some of the fascinating characteristics of the market in the US. Well, to sort of head off or to talk and kick off the conversation, I would say there's four main points that I would want to share with the audience right now. The first one has to do with the economy in the US. Broadly speaking, as I look out the window here on the west side of Manhattan, there's a lot of people walking by. I'm seeing some shopping bags already, even though it's pretty early in the morning. The US economy remains strong. That is sort of our base case for where we are today. It's a bit of a Goldilocks scenario when it comes to our labor market. It's not too hot, but not too cold. It's just right. However, we would say that if there was any sort of risk, either maybe to the upside or to the downside, we're of the view that we are maybe later cycle. And the way that I would describe that in a little bit more detail is if we were assigning probability of there being more of a likelihood for growth from this point in the US economy to accelerate or decelerate, we're of the view, since we're late cycle, that it's more likely that growth will decelerate from here. Again, we don't know, but that's our view, that we think that's possibly more likely. So that's important to keep in mind when it comes to the positioning of our trust today, as we are a bit more defensive in some of the sectors, for example, that we like in the portfolio. Secondly, if you just pull up on, whatever your preferred website is for checking the investment markets, and you look at the valuations of the US market. So when I say valuations, a classic example of this would be something like a price to earnings ratio. The headline valuations for the US market it's fairly undeniable relative to history that valuations look stretched. They look above average when it comes to the average PE multiple of the market relative to the history of the S&P 500. But if you look at that in a little bit more detail, which I'll show you in a few slides, there are certainly, we think, some pockets of potential opportunity. In particular, some of those defensive sectors I mentioned a little bit earlier, they're actually discounted relative to their own histories, and I had a slide on that. And in addition to that, while this is a trust that tends to focus on American companies, because of our global perspective in the team that we are noticing some select multinationals that look attractive relative to US peers, and we've tried to take advantage of that. Now, the third observation from the equity market perspective from where we're sitting is that market concentration, meaning the amount of percentage of the market in just a handful of stocks, is, again, undeniably relative to history, quite high. And I'll show you some interesting slides on that and how it may mean opportunity for active managers, as we think that there may be some dispersion going forward. And then lastly, as I mentioned earlier, we are of the view that things are late cycle in the US economy. Now, we think things are strong, but maybe that higher likelihood potentially of things slowing down from here. There are plenty of opportunity, opportunity buckets, if you will, and we tend to sort of highlight those, and we call them sometimes mega forces, where there is opportunities for secular growth in areas like AI, low carbon addition, when it comes to things like energy and utilities. And the one that we really are leaning into in this portfolio is demographics, in particular, the increased use, for example, of healthcare as populations age in the developed world. So those are at a high level some of the issues or key points to share with you regarding our outlook for U.S. equity markets. These are sort of our four main points of where we are today. Now, one topic of conversation in the U.S., very relevant this year, has to do with rate cuts. And what we tend to do on our team, the income and value team, is, as the name suggests, and as Alan mentioned earlier, we do have a preference for value stocks, meaning stocks that tend to have a lower price to earnings multiple, or we think are trading at a discount to their intrinsic valuation over time. In addition to that, though, our team really does focus on, when we do our bottom-up stock selection for the portfolio, we focus on quality. And part of the reason we're encouraged by having quality in the portfolio is, if you look at history going back, this is to the mid-1980s, we did an analysis of the types of characteristics that tend to do well, again, looking at history, of the characteristics of stocks in the US that tend to do well after rate cuts begin. And in this instance, what is interesting is we find that actually in the trailing 1-year period, 2-year period, and 3-year period, after the first rate cut, and this is data, like I mentioned, going back to 1984, quality tends to outperform the broad market. So for us, we think that this is potentially an interesting characteristic to be leaning into in the portfolio as we are today because of the historical precedent for it doing well when there are rate cuts. And I think that's relevant as we talk about the US economy more broadly. I mentioned earlier in those 4 different key topics, valuations and the opportunity, even though the broad market in the US looks maybe a bit stretched, the opportunity in more defensive parts of the market. Now, combine this with the point I made earlier around how we think that the economy may be higher likelihood that it slows down a little bit as we head into 2025. And we think that there's an interesting opportunity in some of these more defensive areas. For example, if you look on the bar charts here on my left, I'm looking at the screen, healthcare is trading at a discount to its typical long-term valuation average. And this is with data going back to 1996. You see that yellow bar is actually lower than the black bar. So it's an attractively priced, we feel, using historical data relative to its own history. But in addition to that, healthcare relative to other sectors, now this isn't a recession, which would be maybe a bit more extreme than what we think is sort of our base case if there is a slowdown, but it's something that is worth looking at. In a recessionary period, you can see that healthcare actually relative to other parts of the market, again, this is using historical data, actually tends to outperform. So to kind of bring it all together, we are overweight healthcare right now because it has attractive opportunities when it comes to its valuation. Where we are in the market cycle today, if there is any sort of slowdown, history shows that healthcare has historically tended to do well. And there are some of those secular growth trends that I mentioned earlier when it comes to things like an aging population. These combination of things we think makes this a really interesting area of the market today. Another point I made earlier in my prepared remarks has to do with finding select opportunities abroad. Now, I acknowledge that this is an American income trust, but it's incumbent on us to look at maybe the competitors of some of the large US stocks in the portfolio and make that comparison check of them versus their counterparts overseas. And one of the things that is really interesting is if you look at the valuation of the US market today, and this reiterates the point that we are at stretched valuations at the high level in the US today, is if you look at the left-hand side, it shows you the historical range of the price to earnings ratio of the US market. And where we are today, that current dot is even higher than the 90th percentile of, you could call it expensiveness. So the US market is quite expensive relative to its own history. However, once you deviate and go outside the US, that is a different story. Areas like Japan are more in line with their historical averages. And even countries like the UK, for example, are actually trading at a discount relative to their median. So for us, we think that there are some select opportunities in finding those non-US domiciled multinational companies outside of the US. And part of that is because of the stretched valuations we're seeing here in the United States. Now, another big topic of conversation here in the US when we meet with investors and others in the industry has to do with growth versus value. And this is probably the topic I've talked about the most in 2024. And the high level point I would share with you is, as Alan mentioned at the top of the call, is yes, it has been a streak of several years now where growth investing has outperformed value investing. But if you are in any way a believer of mean reversion, of things sort of eventually coming back down towards the average, and looking at history, what you can see here is the difference. This is the difference in the weightings in the S&P 500 of growth stocks versus value stocks. We are essentially bumping up against the highest percentage of growth stocks in that index. And this is data going back to 1989. So where we are today is growth as a percentage of the index is really close to all-time high levels. And history shows that that could potentially set up things for some mean reversion, and that could be potentially quite good for value if there is that mean reversion in the market. Now, a similar fascinating couple of statistics here has to do with market concentration, because there's a lot of overlap in growth accelerating in its size of the S&P 500 and a handful of stocks, I'm sure you're familiar with a lot of them, really being a very big percentage of the market here in the US. And this number really does sort of jump off the chart, or is off the page in terms of the percentage of the S&P 500 today in the top 10 stocks. And you know, sort of casually you hear the S&P 500, oh, that's 500 stocks, right? Just based on the name. You think it's, you know, a pretty well diversified index, but it's quite fascinating to share with you that if you look here, this is the percentage of the S&P 500 just in the top 10 stocks. So 10 stocks out of that, you know, 500, and as the name suggests, you can see that it's around 35% of the index is just 10 stocks. So it really does, and relative to history, going back to 1989, this is well above anything we've ever seen before. So again, in the event of mean reversion, I think this is quite related to that point earlier around that growth versus value dynamic. If this does just sort of come back to average or come back to normal, we think that could be potentially a very attractive environment for value investing. Another fascinating statistic is if you look at the weighted average market cap of the S&P 500 today, it's right around close to $1 trillion. So the weighted average market capitalization of the companies in the S&P 500 is close to $1 trillion, which is an incredible number. But if you just remove those top 10 companies, right, from the index and you rerun the market cap measurement, it's almost a reduction of 90% or close to 90%, where the weighted average market cap comes down to close to 100 billion. And again, this just reiterates the point of that handful of stocks that are mega cap are really skewing the index. And what we would say is there's more opportunity, we feel today, in those more traditional mid or large cap companies, you know, as a ballpark, a generalization, maybe a $50 billion to $200 billion company. We think there's more potential opportunity today in maybe those names than the multi-trillion-dollar companies that have really run up a lot and that are very, very large in the index today. A related point, but I think that one of the North Stars for looking at these things tends to be history and comparing what was happened in the last few years versus the long-term average. And to come back to the point around market concentration, another way to look at this is evaluating the market cap weighted S&P 500 versus the equal weighted S&P 500. And in essence, what this is doing is the equal weighted puts less emphasis on those gigantic names that I just mentioned have run up a lot in the index, those multi-trillion-dollar companies. Now, historically, this is data if you look at the top here going back to 1970. Interestingly, the equal weighted, so getting that benefit of a smaller company as it grows, that actually has materially outperformed looking at the long-term average going back, I shouldn't say average, the cumulative return since 1970. This is going through to nearly today. You see the equal weighted index has materially outperformed the S&P 500. So if you look at history, that tends to be sort of the traditional long-term phenomenon, is that equal weighted outperforms. But let's look at what's happened since the end of 2022. Fascinating that the complete opposite has happened. The S&P 500, so the one that is cap weighted, has materially outperformed the equal weighted. In other words, those large companies have gotten even larger, and it is bucking the trend of the long-term performance that I just mentioned earlier, going back to 1970. And the last point on this I would make is, when you look at history, this is with data going back to 2010, you typically don't see any sort of valuation premium to either equal weighted or cap weighted, meaning they tend to trade roughly in line when looking at valuations. But what's interesting today is those cap weighted companies, those mega cap companies, what it's done is it's skewed the valuation difference to about a 25% premium if you're investing in those in the S&P 500 cap weighted, which again is not normal looking at history the last 14 years or so. So all of this is to reiterate the point that the markets today in the US are clearly quite concentrated. their valuations are elevated. And if you're a believer in any form of mean reversion, we think that there's a fairly strong case for value investing, or at least considering value investing, if you're putting money to work today in the US market. Now, another big emphasis of our portfolios on the income and value team has to do with our affinity for dividend paying and dividend growth stocks. Now, in our portfolios, we tend to have a preference for dividend paying and dividend growth stocks for, one of the reasons is it has to do with what's on the screen here, as you can see. What tends to happen with dividend initiators and growers, this is data going back to the late 1970s, is in a bull market, when things are going well, they tend to do well in absolute terms, meaning they give you considerable upside, as you can see there in the, looks like a black or dark gray bar. When you look at the bull market column there, it's a 19% or close to 20% annualized return that you see from dividend growth and dividend paying stocks. But part of the reason, again, that we're encouraged by this type of investment style as we head into the next year is come back to one of the initial points I made, maybe a little bit more of a risk as we head into next year that the growth in the US market actually slows down a little bit, which could be a more volatile period. And when you look at those types of markets, you can see that the dividend growers and initiators, they tend to materially outperform, while they are still down, on a relative basis, they tend to really outperform non-dividend payers, which, by the way, tend to be a little bit more common in the growth side of the market. And that combination of delivering strong upside when the market is doing well, and actually really strong downside protection relative to other parts of the equity space in the US, your overall experience, believe it or not, with the more conservative dividend paying and dividend growth stocks, overall, if you look at this historical chart, shows that you get more annualized return from this type of investment than non-dividend paying stocks. So we like this type of quality dividend growth style and investment philosophy over the long term, because it tends to historically work out quite nicely. But in addition to that, where we are today, thinking about stretched market valuations in the US, combined with a potential maybe slowdown in the economy, we really are encouraged by that combination of different attributes as we head into next year. Now, I'm going to close out my comments now. I think this is my final slide, just showing you some of the characteristics of the portfolio today. And I'll just highlight a few things, and then Alan, I'll give you a cue now that maybe we'll take some questions here in just a moment. But as I mentioned earlier, if you look at our healthcare weighting there on my left, as I look at the screen, the black bar indicates in the American Income Trust that we are overweight this sector for some of the reasons that I mentioned earlier, that combination of attractive valuations in that sector, the fact that in a recession, now again, that's not necessarily what we're calling for, but in a slowdown, they tend to historically outperform other sectors in the market. Combine that with some of the secular tailwinds we're seeing with an aging population, we're seeing a lot of individual stock opportunities in the healthcare space. And then maybe on the flip side, you can see that areas maybe like industrials, we are underweight relative to our benchmark, which is the Russell 1000 value. In industrials, we would say that the valuations there look a little bit stretched relative to other cyclical parts of the market, because we feel that they are, as they suggest, quite cyclical in how their businesses run. And if there is any sort of slowdown, industrials may see a little bit of a headwind from a valuation standpoint. So for us, we're being very selective in that space. A few other statistics to share with you regarding the portfolio. The underlying gross dividend yield of the underlying stocks in the portfolio is a little bit over 2%. And one of the stats I think ties in nicely with a lot of the comments that I've made already is you can see that price to earnings ratio close to the bottom right of the screen. It's the FY1, so the next year's price to earnings ratio. Let's start with the S&P 500. Aligned with a lot of the comments I've made already, you can see the price to earnings ratio of the S&P today is 23.7 times PE, which is right at or very close to the all-time highs, measuring the you could describe it as the expensiveness of buying the S&P 500. Let's kind of move down the line. Now we look at the Russell 1000 value. That's a value index, so it's going to be, it's lower. It's at about 18.1 times. But interestingly, because of our security selection and us looking at these individual stocks to find, good opportunities, I think it's interesting to note that, as we as a team look for that combination of quality attributes, quality, you can think of that maybe as, for example, that dividend yield. It's a 2.1%. That's a nice healthy measurement. We're getting actually a higher level of dividend yield, but look at our price to earnings ratio in this portfolio. It's only 13.6 times. And maybe I'll kind of end my comments with where we started. Alan started the call by saying, the U.S. market, very, very concentrated, quite expensive at the high level. It's an interesting thing to note that our price to earnings ratio in this portfolio is 10 multiple points lower than the S&P 500. And we think going forward, that could be potentially quite attractive in a market that has been admittedly very growth led, which has not been good for value. And heading into next year, with some of the characteristics I mentioned earlier with our outlook, we think that this is potentially quite attractive. So I'll pause there, Alan, and happy to take any questions there are.
Thanks, Steve. I just wanted to first get a little bit into that valuation difference. I think in the UK we're fed a steady diet of the UK market is undervalued and companies are frustrated because they can't raise equity, and if you can't raise equity when you need to, what's the point of being listed? And there's a kind of, that you can argue whether there's some typical British seeing the glass half empty about it, but it's definitely companies do express frustration about it, and I suppose we have this image in the US of everything being much rosier, but what I'm hearing from you is that it sounds like there's probably a lot of companies listed in the US that do feel unloved and undervalued, and some of the kind of classic signs we look for when companies feel like that are M&A and share buybacks and insiders buying. And I wonder whether there's any kind of data you could share or anecdote you can share that kind of supports that it just sounds to me like a mid-cap company in the US might be feeling some of the same frustrations as a mid-cap company in the UK right now.
Well, yeah, thanks for the point and the comment and the question, Alan. I think one of the sort of anecdotes and the themes that we're hearing as we head into next year is this concept of the market broadening out. And we're pretty encouraged by that as we have more of an emphasis on value and a little bit more of an emphasis on being lower in cap with regards to large and mid-cap names. Now, one thing that does come to mind is, it's our view potentially next year that it could be an environment that is maybe a bit more accommodative from a regulatory standpoint and also an M&A standpoint. So in thinking about potential catalysts, and there are others, I don't mean to say that that's our lead catalyst, but a potential catalyst where you could see the market continuing to broaden would be maybe increased levels of both of those things next year.
And do you want to talk a bit about healthcare? Because I suppose that that's one of those sectors that has also come to dominate a lot of people's thinking, mainly because of two stocks, one of which is US listed and one of which is twice the size of the GDP of Denmark where it's listed, and probably everyone knows Novo Nordisk and Eli Lilly, and those kind of could give you an impression that healthcare is, let's say, the valuations are fully up with events, but that's not really the case across many other areas, is it? Do you want to just expand on some of the kind of technologies and services in healthcare that you're seeing where valuations are more attractive?
Yes, a couple of great question. A couple of things come to mind. For example, we've seen some opportunities in more of the medical device space. So believe it or not, we're still seeing a little bit of a backlog as a result of COVID in some medical procedures. And as those happen more and more, there is more potential opportunity we feel in some of the medical device names. And then another quite interesting sort of analysis that we've done has to do with large cap pharmaceuticals, where, as you mentioned, there are some names out there, that look attractive with their current sort of book of drugs available. But actually, interestingly, in the U.S., we've done a lot of analysis on some names that may face what is called a patent cliff when it comes to the drugs that they have in their sort of arsenal, coming off patent, and then obviously losing a lot of their ability to generate revenue for those companies. So one of the things that we've leaned into, I mentioned this a little bit earlier, is sort of the concept of this non-US multinational. And we've actually found a lot of opportunity on a relative basis of looking at some of the large cap pharma names outside of the US where they have less of that patent cliff concern versus some of the US names where it's a lot more prevalent. So those are two, I think, interesting themes that we've leaned into, is a little bit more on the medical device side, and then just that interesting phenomenon of US versus non-US pharma and how there's less of an impact with regards to patent cliffs, we feel, in some of the non-US names.
Mhm. And then, do you want to just talk briefly about specifically the investment trust's dividend policy, which is it's a way to marry up the, even with an equity income strategy in the US, yields are lower than in the UK. So you have the trust has a specific dividend policy, doesn't it? But also, so for example, with interest rates coming down, and if your thesis on late cycle plays out, then perhaps interest rates do come down in response to that as a stimulus. Then does that have a positive impact on underlying dividends of companies? What's the kind of underlying
Sure.
dividend growth? Because it's not necessarily apparent, is it, within the specific policy of the company, what the underlying dividend growth is?
Yes, that's another great point. So, interestingly, there's sort of two forces at play that we think could be really supportive for dividend and dividend growth investing as we head into next year. And Alan, you mentioned one of them, which is on the front end of the curve, Fed reducing rates. So if rates come down in the U.S. and globally, it could create more of a attractiveness for dividend paying and dividend growing stocks as people look for income in other sources, and in this case, looking to the equity markets to source more yield for their portfolio. But concurrently, which is actually quite interesting, is if you look at longer in the curve, some of the rates have actually moved up, as there's actually a little bit more concern of inflation being stickier in the U.S. than people may have estimated previously. And the reason that is actually quite interesting is if you look at history, in a lot of inflationary environments, dividend growth tends to do quite well relative to other income producing parts of the market. So if rates come down on the front end, we think that it creates an interesting opportunity for income and dividend paying stocks as people look for more income. But simultaneously, as if these companies and how they price their goods and services, they can sort of isolate themselves as best they can from inflation by increasing those prices. That will translate to their, theoretically, their earnings and their dividends, and they can sort of keep up with inflation. And that characteristic is quite unique to dividend growth stocks and equities relative to other asset classes, where if there is higher levels of inflation, they have tended to underperform. So in sort of either of those cases, we think that there's strong potential for the portfolio relative to other parts of the market.
Yeah, and on that, you mentioned the strategy's multi-cap, and so it moves down market cap bands. And some of our viewers will know um, from other presentations that further down the market, there are some big valuation gaps. How do you allocate capital across the bands? I mean, smaller companies are more risky. We don't need to have a long conversation about what that means, but I think everyone understands why I say that. So, presumably there are limits, but are you seeing more opportunities now than in history for the trust further down the market cap band?
Yeah, I would say that the biggest opportunity that we're seeing has to do with more that traditional large cap stock, right? So think back to a couple of slides I showed you earlier. Now we're talking about multi-trillion dollar companies. If you just think about that in terms of relative to the size of the US economy, I don't think it's controversial to say it's much harder for a $3 or $4 trillion company to, I don't know, this is theoretical, double its size to become a $7 trillion company, just given the size of the US economy. But where we're seeing more opportunity, Alan, is in the more traditional large cap stock. And some of that does kind of blend down into the mid cap names as well, where a $50 billion company, $100 billion company, for them just mathematically, without giving an example, to double in size relative to the size of the US economy, we think that there's more potential opportunity in that occurrence. And just in how we do our analysis, this is a team that runs portfolios that are large cap, runs some portfolios that are a little bit more specific to mid cap. For this portfolio, we like that ability, that flexibility to go down a little bit, not necessarily into small cap names, because to your point, I think that's a different, risk return dynamic and profile. But mid caps, they tend to be more sound businesses relative maybe to small, maybe a little bit less volatility. Again, just on average. And we think that there's a sweet spots there of if you follow my sort of point here, is like the larger mid cap names and then also the smaller large cap names. That's where there's a lot of opportunity in the US, we feel, in general.
Mm-hmm. Yeah, I see. So, um, this is entirely coincidental to my final question, but I've just had an offline request from one of your colleagues to move the slides onto the risk slide because this is being recorded, so we need the risk warning.
We'll move through all of them just to, for the sake of the recording. Let me make sure I go through all of these and give them all a moment here.
And maybe my last question does need a risk warning because I think everyone in the audience will completely understand that you will have to be limited in what you can say, but clearly anyone thinking about investing in the US right now is considering the incoming administration, and there's plenty of commentary on that for people to go and read. But what conclusions or what can BlackRock say about the situation reasonably without getting into kind of speculation? And there's plenty, as I said, there's plenty of that out there, so we don't need to go over that. But it's obviously a big topic, isn't it? So
sure. Well, maybe I'll bring it back to the fundamentals of the companies that we're looking at and some of the things that we're hearing in conversations with company management or even with the sell side. I think it's fair to say that we will continue to monitor the new incoming administration and look at the policies and how they may impact the fundamentals of those underlying businesses. I think a lot of conversations are being had around potential tariffs. That's something we'll keep a close eye on, and then immigration policies and other. We'll just monitor it and see how those flow through the fundamentals of companies. But I'll probably leave it at that to not go too.
I think that demonstrates great wisdom on your part. And with that, as I just mentioned, everyone on the call now knows this is being recorded, so you can refer back to it if there's a specific section you wanted to look at. The slides will be available to download if you haven't already. If you register on our website to be notified of any updates, you'll get an email when the recording goes up. Obviously, BlackRock's own website is a great wealth of information on the trust as well, and hopefully so is Kepler's website more generally. So I thank you, Steve, once again for a relatively early morning. Time for your second coffee now, and thanks everyone else for joining, and we'll see you on the next one.
Thanks, Alan. Take care, everyone.